will be the first day. Saturday will be the first day of winter. So happy winter to everybody. And it means we've come to the end of the notional autumn selling season. The season, though, does keep going through June until the end of June. Of course, then we have the August lockdown, the August pause in the market, and then we pick up again the July pause, and then we pick up again in August. But it's been a very positive start for our housing markets this year. Of course, last year was a revival year, which followed the easing we had in 2022. Of course, no surprise, given we had our first interest rate increases 2 years ago, Rich, since we had those interest rate
Wow.
increases. And we've had 13 rises in interest rates. And look at how well the housing market has continued to respond. But 2 years into interest rate increases, of course, that caused a little bit of nervousness in the market in 2022. Markets backed up quite strongly last year as a lot of buyers started moving back into the market, taking advantage of those value opportunities because prices were around 10% lower at the beginning of last year compared to where they were in 2022. And of course, as usual, our markets revived, recovered, and we picked up that 10% plus that we lost in 2022. And the interesting thing, Rich, is that we've consolidated that growth of last year, this year, and we're on track. Maybe not so much for 10%, but some of our markets may get close to 10% growth again this year. But certainly it'll be, I think, 5 to 7% growth, and got to understand that that will come off what was a very strong year last year. So that's part of I guess, the comparison when we do see those annual results. It's about also where we've come from, not just where we are. But the big difference we've had in the big difference we've had this year is last year was driven by buyers and this year's being driven by sellers. Sellers are certainly quite interested in getting back into the market. Of course, it always works that way. The revival market is about buyers coming in looking at value opportunities. Of course, sellers have more skin in the game, so that takes them a bit longer to regain their confidence. But they've got their confidence back now, and we're seeing, which we'll look at some data, which shows just how strong actual overall activity has been, which is a reflection of all the listings that have come back into the market. But I better get on because we've got lots of slides to cover. We've got some, Rich, some QR codes here, so I don't have to go through all the data. That those that are interested can take a picture of the QR code and it will take them to a link to some of the reports that we're going to look at.
Right.
So I'm not going to go through everything in detail. We want to cover some questions coming through, so we want plenty of time for some Q&A at the end. So let's
Awesome.
get rolling. My brand is My Housing Market. I work as an independent commentator and analyst for the housing market. We also provide our own in-house data, so we are competitors to the big housing market data providers. But it's not just about house price data, it's about all those other bits and pieces that go together to make the jigsaw to tell us what's happening what's happening in housing markets. So we like to do that. It's about correlating evidence so that our opinions and our insights are quite robust. But as our little slogan says there, current state and future prospects of housing markets, it is all about really focusing on what's happening now. So that's the current state. That's why we like to look at as much data and insights in real time, so our those that are listening to us can have a sense of what's happening now, not what's happened 3, 6, or 12 months ago. So I think if you're talking head in anything, Rich, you should have some qualifications. So I've got a couple there and I think it's important to have them in the field that you're discussing, and I have them in housing market economics and also some qualifications in research, which I also think is important if you are providing analysis, that at least you know how to do formal research. I'm also a member of the Royal Institute of Chartered Surveyors, which is a high-end professional body, and my skill set there, of course, is measurement in the housing market and the broader economy. And I've also had a lengthy career as a property economist. My last formal role was as chief economist for the Domain Group, but I've been operating as an independent voice since then. And as with you, Rich, we do tend to get our heads up and about on the media occasionally. I don't think, well, what does that count for? Well, I suppose it's
Well,
something.
it's good acknowledgement, mate. You can give the 10-second grab with a bit of confidence. That's what you do, mate. You can cut
Yeah.
through. That's what you do.
Yeah, it's getting a little harder to sort of get on board because they really are looking for the extravagant grab, these days. So, and I'm not big on extravagant grabs. It's about, being a little bit more
Yep.
conservative and
Mm.
giving people information they can use. Not that's going to scare the bejesus out of them, but nonetheless, there we go. So, but we are about our wonderful housing markets, and there they all are in their glory in their capital cities. And prices are still rising, Rich. We're just about to release our May housing market report. That will come out on Friday, so everybody look out for that. And it will show continued growth in house prices in just about all our capital cities. In fact, all of them bar one. So I'll let you read that report. But the data has been quite positive this year so far, as I said, consolidating what was a strong year last year, a year of recovery. So almost everywhere prices are rising. And when we talk about a housing market, Rich, we always focus on the big three, which is people, and that's about migration. And migration has driven particularly the higher demand in southeast Queensland and Queensland generally, really, over the last couple of years once the lockdowns finished. Well, really, when the lockdowns were still going, and that really did drive an exodus out of Victoria and New South Wales, particularly Victoria, into southeast Queensland, and we've seen booming prices and rents as a result. And of course, we now have the reintroduction of mass migration, which Australia has done traditionally for decades, and that's putting pressure particularly on our rental markets. And there has been some changes. The government's desperate to get rid of that rental crisis, tag that we all sort of use, which is probably reasonably appropriate given how high rents are and how long the queues are for people looking to rent a house. But a lot of that demand is coming from the return of students. And of course, we've had the students coming back in, but none of them are going out because none of them have been here for the last 3 years. So it's a sort of an inflow without the outflow. So that's going to have to take a year or two to adjust. And I think the government's sort of trying to fiddle with that to take some pressure off the rental market. But good luck with that. But migration is important, of course. But it's been the swings and roundabouts through COVID that's really created this imbalance in our housing market, in recent times. And we're still waiting to find that balance again. But on the supply side, of course, home building is important, and that's come at the worst time now with these issues with migration, because we basically stopped building, 8 years ago, Rich, as you know, and we're chronically undersupplied for housing.
Well, I'm sure you're going to show the charts that's showing that inflation is just going through the roof, and building approvals are decade lows. So it's the worst combination at the moment.
Yeah, it never rains, it pours, and we're paying the price big time for that. All those, the red tape, the green tape, the higher building costs, it just makes it, just when we need more building, we can't get it. And we're still heading south in terms of the underlying trend. It's a systemic problem. It's not something we're going to fix maybe ever, Rich, which makes property ownership and investment.
Well, this is the key point. I guess a key point I want to bring out of today's presentation, Andrew, is that even though it's a really difficult headline to absorb, it should actually give people a lot of confidence that it's safe to invest. You've got a structural problem in supply with housing, and therefore investing in housing, not only are you making money, but you're solving a social problem as well,
That's right. And the interesting thing, Rich, is that we're not alone here. So it shows you something big's happening, because the US, the UK, Europe are all suffering from these issues of undersupply, of being unable to match demand for housing, with supply. And it's been about these, I guess, largely ideological sort of, initiatives in housing over the past decade or so, which have failed miserably. And here we are, we find ourselves without enough housing, high rents, high prices, and people having to really think about whether they can even get into the housing market, and it's going to cause social change, Rich, as you've said, because you just can't create houses out of water. It's not just magic stuff. You've got to, it's a big journey here, and it'll mean people stay at home longer, that they share, that they move out of the state, maybe out of the state, but out of the capital city, because they've got to find shelter somewhere. And as I said, this is a worldwide problem.
Well, we're definitely seeing those demographic trends. We're seeing a lot of people that can't afford Sydney and Melbourne in particular heading north over the border to Queensland, or to regional areas like Geelong, Newcastle, Central Coast. And then we're seeing a lot of people even move to Adelaide or even Perth, to other areas too. But then you've also got on top of that all the migrants, 380,000, or it was 600,000 the year before, coming into the cities, and we need jobs. And I think cutting migration is a false economy, in my view. We should be addressing the supply issue, not the
Yes.
demand side. And unfortunately, I don't want to put my politician's hat on, but the Greens and even the Libs trying to talk about cutting housing policy is ludicrous. We need zoning changes, we need
Yeah.
incentives for investors.
Yeah.
Unfortunately, there's not enough time to have a rational debate about this. But I think the point out of today's webinar is that the market is very strong. And
Yes.
love to see what your charts are saying about all these figures you've got here, Andrew.
Yes, Rich, it's we're paying the price now for the I guess the ideological view of the market that it would, that governments would control the release of land and etc. And we've just got so far behind, and we'll look at some data to really reinforce that we can't fix it, and this means social change going forward. And governments are under a lot of pressure now, Rich. They're under a lot of pressure because people are not happy if they can't put a roof over their head. And they start looking at some of these more extreme political parties for solutions. And we're seeing it in Europe, the UK, we're seeing it in the US, that people are just, they've had it with the fact that governments have been unable to provide housing for them. And it really does reinforce what an essential commodity housing is regarded as. So yes, supply and demand, migration and home building, and the economy is all about interest rates. We're going to have a good chat about interest rates. So let's start with that. The economy and interest rates, of course, are important to housing because higher interest rates with a given income mean you've got to pay more for a house, so it makes things less affordable. If you get a lower interest rate, well, with a given income, it means you can pay more for a house, so it makes housing more affordable in theory. So let's have a look at our journey for interest rates. It's been a bit of, these are mortgage rates here. We see that roller coaster ride through the last 20 years, higher rates during the mining boom because we had too much demand, similar to now. But then the GFC forced us to cut rates to try to stimulate demand. Australia went pretty well after the GFC compared to everybody else because we had another mining boom. Thank you, China. But eventually that ran out of puff and we had to join the rest of the world cutting our interest rates, and down it went until we got to that zero level of official rates during COVID. But of course, all those stimulus packages through COVID meant we had way too much demand, which is fine. It had to happen. We didn't know what was happening in COVID, and the government had to throw the kitchen sink at it. It just meant we couldn't match all that demand with supply. So hello, inflation, and the highest inflation for decades. And so that meant, yes, that's right, higher interest rates. And we're just starting to look like perhaps we're coming to the end of the inflation story, which is good news. And we'll look at just how that's panning out at the moment. But mortgage rates at 8.8% now. Official rates have been on hold for 4 months. And I think the outlook's for steady rates, but we'll check that out in just a second. But we're here about house prices. When we look at how house prices respond to interest rates, you can see there that actually prices ease rather than fall when we have higher rates. What happens, of course, is buyers and sellers sit on their hands because of the doom and gloom as rates rise. But then when we get some clear air and confidence returns, maybe lower interest rates, we see not just the normal demand, but all that pent-up demand is released. So we get very strong results. And you can see there with the top cycle, Sydney, the gold cycle there, very strong growth as they came out of COVID. Similarly, Melbourne, but not as strong. And that's because that Melbourne lockdown certainly was severe. And I think that Melbourne market's still doing it hard because of the negativity of those severe lockdowns. Brisbane boomed in Brisbane, particularly given the surge in migration out of the southern states. And as you mentioned, Rich, the affordability advantage that Brisbane had made it fertile ground for those southerners moving up there because they're thinking, hey, look how cheap things are here, rent and prices. And of course, not for much longer, I think Brisbane will be regarded as a cheap property. But yeah, very strong growth through the post-COVID and the COVID period in Brisbane. Adelaide, similarly, quite strong growth, driven again by higher levels of interstate migration from those refugees heading out of COVID lockdowns. And of course, Perth's the big story now. It's really rising strongly, but it had a long period there of very subdued activity following the end of the mining boom. So it's sort of in catch-up mode and still quite an affordable market compared to the other major capitals. But talking about Brisbane, Rich, I think we're heading for $1 million median in Brisbane sooner rather
I
than
wouldn't be
later.
surprised. That's where I put my money, mate. I bought a couple of properties up there last year, and I'm encouraging my investors to follow suit. Yeah.
Well, I think we're going to have $1 million median before the end of the year in Brisbane. Latest price data remains positive. In fact, the whole of Queensland is very strong at the moment. Even the smaller regional markets on the coast are certainly catching up with some of the underperformance they've had over the past decade. I'm talking Townsville particularly. But yeah, strong growth there. Hey, here's an interesting piece for you, Rich. I think the Brisbane median house price might get higher than Melbourne next year
Well, that's
sometime.
it.
You
That's
know?
yeah. But for how long? That'll be the
Yeah, that's
question.
right. Well, Melbourne's just sort of percolating. I think it's
Yeah.
waiting for the go button to get
Talk
pushed.
about a groundswell of pent-up demand. Actually,
Yeah,
just
yeah,
to go back to
absolutely.
your point about what happens typically when rates rise. A lot of people think, as you say, when interest rates rise, that there's an inverse relationship between
Yeah.
interest rates and property prices. As you say, we've actually got experienced a period of time where we've had interest rates rising and property prices rising.
Yes. Yes.
And I think, as you say, there's a catch up. But my prediction is when they finally cut rates, which might be possibly November, December, if at all this year, that will reignite the market. And my advice to both home buyers and investors, if you do want to get ahead of the curve and buy when there's less competition, strike when you've got the ability to buy. Don't just wait for the perfect interest rate number to appear on the screen. Buy when you can afford to buy, and you'll buy better than buying when 15 other people are standing next to you at auction.
That's right. And of course, we can see a lot of what is left of pent up demand will be released if we do get lower rates. I'm not sure we will towards the end of the year.
Mm,
But when we'll look at a moment, the government's sort of done some work in the budget to maybe make sure we do get at least steady rates in the outlook and maybe a cut going forward.
mm.
But we'll have a look at that quickly. We've got to get through our slides or we're going to run out of time, of course. As I mentioned, the Reserve Bank left rates on hold over May. No surprise there. We've had 4 months in a row or 4 meetings in a row on hold. Economy's still going really well despite those 13 rate rises over the past year. Still got a low unemployment rate, just starting to tick up a little bit now. We shouldn't be surprised, but still quite low, just over 4%. Jobs are still surging, number of unemployed is falling, participation rate is still near record highs. That measures the proportion of people who could work that are actually working. We had the latest retail sales data out this morning, Rich. It was higher. So retail sales, of course, they're not as high. Well, they are as high as they were during the COVID stimulus period, but the trend growth is starting to ease. But we shouldn't be surprised at that because that stimulus packages, we all got out and spent like drunken sailors. So, of course, and we're still well ahead of where we were prior to COVID with retail sales. So people are still happy to get out there and spend on retail. And that's regardless of the fact that we've got more migrants and inflation has pushed up the value of retail sales as well. So all positives there, despite all those interest rate increases. And it's when we look at inflation, housing, food, and fuel are the main drivers. We're going to look at fuel quickly or closely in just a second. I believe that rates are likely to remain steady. A higher inflation recently obviously was a concern. But we're going to look at some of the statements that the Reserve Bank made in relation to their outlook for interest rates. And I think this is the first one. This is what the governor said in their rate decision just a couple of weeks ago, and that they're not ruling anything in and out, basically. So they're just sort of saying, well, we can do anything. We're not giving you any clues, all right? But they did give us some clues in the actual press conference, which the Reserve Bank governor now holds. And I think this was quite illuminating that they said that they really think that inflation has to be persistent and significantly above forecast before they tighten interest rates again. I think that was a big clue that they say, look, we're not going to do anything here until it's really obvious that this is a
Yeah,
breakout in inflation again.
yeah,
I think that was really important
yeah.
statement. So just reinforcing that, I think the outlook is especially for steady rates, and it would really take something special for rates to increase. And we'll look at the impact on
Well,
oil.
Andrew, I think just to that point, often it takes a long time for interest rates to rate rises, sorry, to filter their way through the economy. And I think we're now actually seeing rate rises actually hitting people's buying behavior because people are cutting back on spending. They're not going out as much. The cost of their mortgage is high, so they're reevaluating. So it takes, 6 to 12 months or even more for that to flow through. So for inflation to really get down is going to take a little bit longer. But I reckon they're done in terms of rising. I think the next move will be down. The question is it going to be November, December this year or February, March next year. I don't know, but it'll probably be in one of those months at least.
Well, speaking to lower rates, and I think we had a little bit of hysteria in the media earlier this year. And gee, should we be surprised at an hysterical media chasing headlines with silly predictions of lower interest rates? But we had a question from one of the members of the media at that press conference, and I thought this sort of said it all when that particular journalist asked the governor, "Well, what do you say to people who are expecting and budgeting for a rate cut by the end of the year? What is your message for them?" Well, the journalist got plonked big time right across the head by Michelle Bullock. Good luck. And she said, "I hope I didn't give them any impression there would be an interest rate cut by the end of the year. I certainly don't believe I ever gave people that impression. So see you later, mate. Go and find another story."
Yeah.
But I thought that was also good because it did sort of, it's really consolidated and solidified the view of the Reserve Bank, which is, interest rate rises have got to really come off the back of some pretty heavy duty increases in inflation. And nobody's really talking about interest rate cuts at the moment. And I think that's a good thing because it just creates that everybody wants an interest rate cut, but it does create those disturbances in the market. I'm getting a little bit of a blip with my internet. Are you getting that at all, Rich?
A little bit. I can hear you perfectly, though. Your voice is coming through. That's okay.
Slides are just a bit slow. Here we go. Anyway, that's the chart for our interest rates. You can see we've just started to official rates have now started to ease, and I think that's the outlook for rates. Now, the federal budget was interesting, Rich, particularly concerning, obviously, the big two problems in housing. Rents, nothing was done, nothing can be done. All they did was improve the rental assistance package up by 10% for those that have welfare already, so they get an improved position in terms of their assistance for rentals. But putting it all in context, the average rent for rent assistance is about $300 a week. They get around about $100 a week, those that are on rent assistance, for assistance. But the current median asking rent for a house in Sydney is $800 a week. So that's massively ahead of what the rental assistance is. But this is all about those that are really doing it tough in terms of finding housing, and then those on welfare. There's around about 1 million of those welfare recipients that are on rent relief. But so nothing can be done really to improve the terrible situation in the rental market. But the really interesting thing in terms of interest rates, Rich, was the fact that the government is now offering a $300 a year handout for electricity bills for each household. Treasury has predicted that will take inflation off by 0.5%, and they believe that will bring the inflation rate down to 2.75%, and that brings it within the Reserve Bank's target. And they're thinking it might even happen this year. And if that does happen, well, maybe your thoughts on an interest rate cut might
I've
come
got to
true.
say that the $300 equivalent to 0.5%, in my mind, that seems a very high percentage attributed just to power. Is that right? Is that figure correct in your mind? 0.5% cut due to a $300 handout. Does that sound right?
I think they've got to get their numbers right, because the last thing they would want to do is to have to say, "Oops, we got it wrong." Particularly given it's an election next year. What a surprise we've come out with this to take effect next year during an election year.
I just think it's overstated.
We've got inflation down. Hey, we've got interest rates down. Hey, vote for us. This is obviously now. Look, it's a good thing we want lower, but you've got to remember this is a one-off. So the following year, sorry, back to you lose your $300 and whatever comes along. Now, the point to this also is this implies that none of the other things that are driving inflation are going to break out, like housing costs and fuel, particularly oil. So that's got to remain reasonably steady for this to really be effective, to the point of that 0.5% cut in the inflation rate. But look, the government's done something. This is a good thing. And it'll be interesting when the Reserve Bank governor or the Reserve Bank meets again in 3 weeks' time, just to see what their opinion of this is, because they didn't know this when they had their last meeting. Now, in terms of undersupply, the government can't do anything, as you mentioned, Rich. Planning is all about land plannings for the states and the local government, so the federal government can't really do anything significant. They have offered a lot of infrastructure packages for state governments to assist them in new building. That's fine. That's good. Now, they've said here, and this is a wishing and a hoping and a praying, that they get 1.2 million homes, they hope, new homes, over the 6 years to 29-30. Now, that would average 200,000 homes a year, Well, mate, the latest data to April shows to April, yeah, to April, or is it to March? Anyway, shows us that we've just built 150,000 last year. Now that was approved, not built. So the target's 200,000 a year every year, and we're just at 150 approvals so far. So good luck, but it does show you that look, at least there's a positive policy there in terms of the infrastructure provision. But gee whiz, mate, there's a long, long way to go to get anywhere near. And even that 200,000 a year will just match new demand coming in.
Exactly. I think it's a fancy look. It's great to have a target, absolutely, but it's got to be supported with sensible policy. Both, the federal government level, they should be giving more incentives to property investors, not less.
Yeah,
And
absolutely.
and at the state level, they should be offering councils some sort of bonus that achieve housing targets.
Yeah, absolutely. So anyway, that was the budget. Inflation was higher, and that's got the sort of put the cat amongst the pigeons to some degree over March. We're getting the April data out tomorrow, so we'll know what's happening there. We are a hostage to the price of oil, which will be a little higher again because we're looking April to April, and we're nearly into June, so it's very backward looking, this data. So it was up from 3.4 over February to 3.5. This is sort of ancient history in a way, but this is what did shock the market and start talking about higher rates. Underlying inflation was also up to 4%. From 3.9%. And underlying inflation is the measure that's preferred by the Reserve Bank. And again, it was housing and food that were the major contributors. Fuel was up 8.1% over the year to March, which was higher than the 4.1%. And underlying inflation is still well ahead of that target of 2.3%. We can see our inflation rate has started to fall. Like I said, there's a little backward looking here. Our inflation rate's similar to the US, but our interest rates are actually well below the US, our official rate. So a little bit of tension there, which means we won't necessarily follow the US if they do cut rates. I think it's important, this chart shows us how closely we do follow inflation and the price of oil. As the price of oil has fallen, guess what? Inflation has fallen. Guess what? As the price of oil increased over the past 6 months, inflation has increased. So it's very important to look at the price of oil. It will be a key determinant of what happens with inflation and what happens with our interest rates. We'll look quite a little bit closer at that. Good news, sort of good news, bad news story. Unemployment up, still very low, but we're now starting to see unemployment rise a little bit. So that's good because it stops people spending. They're worrying about job security, etc. But the numbers are still very good there, and we're still quite robust in terms of all the states experiencing low unemployment. You can see there we're still quite low, but the trend is starting to rise, and that's, as you discussed, Rich, the longer term impact of interest rates finally starting to work its way into, starting to ease what is a very, very strong economy still, and really a full employment economy still. So it's got some yards to go there before that, I think, has an impact on inflation. But we all want to see, the perfect outcome here, lower inflation and still low unemployment. Sydney and Perth are still the lowest of the capital cities for unemployment in the latest data, with Adelaide quite interesting. Its unemployment rate is actually lower than a year before. The other capital cities are higher, so that shows the trend. Wages growth eased a little bit, down to 4.1% over the year to December. Again, backward-looking data, down from that very strong 4.2% increase. So not good news that wages are still rising strongly because people go out and spend, puts upward pressure on inflation, because employers, if they don't get the productivity gains, they have to cover the higher wages by putting up their prices, and we don't want that. We want the productivity gains that are supporting higher wages, but we all need to cover inflation. You can see there the big surge in wages that we've had through the post-COVID period, just starting to ease off a bit, but not far below the increases we were getting during that very strong mining boom period in the noughties. Retail sales, I mentioned, they were up. Latest data out today, up by just 0.1%, but still holding up 1.3% over the year. The ABS seems to want to talk down retail sales data. I'm not sure what that's all about, but certainly still up 1.3% over the past year. Shows that there's plenty of spending going on, and that followed that 0.4% fall over March, and we're still well ahead of where we were compared to the pre-COVID period. So we love spending, and we're still doing it. And as I said, we need the productivity gains to be covering our spending if it's coming from higher wages.
Can I just
Oil
ask
now.
you one quick question, just on productivity, if I may? Like, there's a lot of talk about productivity. I don't know if people really understand the implications of it. You know, we talk about productivity declining.
Yeah.
What's the impact of declining productivity on property prices? Is there a clear link between the two?
Well, it just impacts the capacity to repay a mortgage because it's the issues are there with wages. You know, if productivity, because most of our wages are based on productivity returns. If we don't have the productivity, we don't have the wages growth. We don't have the wages growth, we can't afford to pay because our banks obviously very tightly control our
Mm,
capacity to borrow.
mm,
So that is important. We don't have the productivity that is reflecting wages growth at the moment, and that's problematic for the Reserve Bank. Although we are starting to see wage growth easing,
mm.
that's problematic because it does put upward pressure on prices because employers have to cover those wage rises with higher prices, else they go out of business. You know, so they have to do that. And what we're seeing, particularly in the services sector, is that breakout because of higher wages from
Yeah,
employers having to push up service costs.
yeah,
You know, and that's what's been driving inflation. Just look at what a cup of coffee costs you these days, Rich,
yeah.
as a sort of a classic example. But
Mm,
the good news going forward, and the good news on rates in relation to oil, is that the oil price is now falling, Rich, which is good. That the trend is now consolidating. Nobody's saying this is going to be permanent, but we were pushing up above 90. That pushed up inflation. That got the chat about higher interest rates up and running. But now we've reversed that, and a lot of that is because the US has increased its oil production, released some of its reserves. Of course, the US is also heading for an election this year, and the last thing they want is high petrol costs in the US. And we all know the story. When we look at our Bowsers, most of our capitals are now, I think it's ran about $1.60, $1.70 is the price of petrol. It was up around $2.50 not that long ago, and that's what was driving higher inflation, and that's what drove the conversation regarding higher interest rates. So keep an eye out on the Bowser, and that'll tell you the story about where inflation's heading. And as I said, we need to keep seeing the price of oil fall to keep downward pressure on inflation, regardless of electricity. And that's what the government will be hoping for, let me
mm,
tell you, Rich, is that the price of oil, which has just started now to ease off a bit, that continues in its downward spiral. But, you know, OPEC probably aren't that happy that the price is falling. I think they were behind the higher prices we were getting earlier in the year. That's the oil producing cartel. But as I said, the US has been quite proactive in getting more oil into the marketplace, and that's put downward pressure on the price of oil, which will work its way in coming months if it continues into lower inflation. And you know, if we do get that with the electricity handout, it may end up having at least a significant conversation about lower interest rates. House building costs have also been contributing to higher inflation. Worst possible time. You know, we need more building, and now house building costs have gone through the roof. Previous government's home builder package was the catalyst for that. Another stimulus package through COVID. We didn't have the tradespeople or the materials to cover all the demand, so building costs went through the roof. But the good news is that we're starting to see some easing in house building costs. So let's look at the annual change in house building costs. It's now down to 5.2% on our latest index measure. So even that's still high and puts pressure on builders, no doubt about it, but it's heading in the right direction. So let's hope that continues. So it means that house building becomes more profitable, and we need as much house building, profitable house building as we can. GDP numbers, just a quick look at the economy, just flattened a little bit. The recent GDP numbers, annual GDP down a little bit, but still chugging along. But you know, this is the real economy is more important when we're looking at this, particularly the implications for our housing market. But nonetheless, this has implications for interest rates. So let's put it all together. We've looked at some of those key factors, Rich. We'll put it together and tell us, let's understand perhaps what this means for the outlook for interest rates. So inflation is rising, but it is backward looking. That's the March data. We get the April data out this week, and well ahead of the target. So that really has upward pressure on interest rates, as we know. Oil price is easing. I think that gives us a steady outlook for interest rate. House building costs are lower. They're still high. I think that gives us a steady outlook for rates. Home rents are still rising, and that is a significant factor in inflation. So I think that gives us upward trend on or an upward bias on interest rates. Jobless rate is higher, but it's still quite low, historically low. So perhaps again a higher bias for interest rates. Wages are rising strongly. We've spoken about that, the implications for higher prices if we don't have productivity go so high. But retail sales up marginally, still high. I think the outlook there, because the trend is easing, is steady. House price growth is continuing strongly, solid to strong. I think the Reserve Bank would be a little loath because they have a bit of an over focus on the housing market, in my opinion. And I think if housing markets were chugging along as they are quite nicely now, they might be a little wary about cutting rates because that might, they think, bring on some unsustainable growth in the housing market, whatever that means. So let's say that that's a factor. Our rates are below the US, as we've said, but our inflation is ahead of the US. Steady outlook, and the recent focus on early cuts in the US and the Eurozone have faded. So steady. Economic growth is slowing. So maybe there's some downward bias on interest rates there. And the budget initiatives to reduce electricity costs, I think that gives us a steady outlook. So what I'm trying to do is sort of paint a picture here of the outlook for interest rates. And I think quite clearly now the bias has swung towards the outlook being for steady rates going forward. I think that's a good thing for certainty and predictability in our housing markets. But I think we've certainly shifted the conversation from potential higher rates, and the Reserve Bank has conceded that, to potential lower rates. We mentioned migration just quickly. We know migration has boomed. Look at that net migration number, really through the roof post-COVID. Where are they going to live, right? So this is net annual migration.
You got a couple of rooms at your place for them, mate?
No way, mate. I'm sorry. I'm already full up here. Yeah. And we can see there that the gold chart there is Queensland, and that was a big rebound. But now with international migration up and running, Melbourne, New South Wales and Victoria are heading above Queensland, which is still quite strong. New South Wales is the top destination. This is backward-looking data from the ABS, but it's the latest we've got. Top destination for overseas annual migration, New South Wales, which is unusual because it's usually Victoria. And I think Victoria will eventually turn that around and become the most popular state for international migration, and that has some good connotations for what will happen in what has been an underperforming housing market. And that's the Queensland numbers. Wow, look at that. All those interstate migrants flooding in, or this is net migration. And that's why we've got such strong price and rent growth in Queensland. Supply, we've sort of alluded to supply. Latest supply data showed approvals were up 3.7% following a February fall. Been a bit up and down. It was because units were up, and they're a volatile number that tend to rise and fall month on month. Victoria was the top performance, total over March, up by 3.2%. But annual growth rates remain chronically depressed, as you can see there, going nowhere. This is national home building approvals and just trundling along the bottom and going lower and lower, despite all the good intentions of governments over the past couple of years. And we can see this is the data from the month. Units, houses and total up over the month. Units down over the year to date. And of course, when we look at the full year-on-year comparisons, not good. And that shows you why we're just sort of, going nowhere fast in times trying to resupply our housing market. When we look at the capital city position, we can see how really, except for that home builder policy of a couple of years ago, that we've collapsed our building, and we're down 38.5% since our peak back in 2015-16. So how do you cater for particularly a resurgence in migration? But units are the big problem here, down 56%. Look how units have collapsed. The building approvals for units have collapsed since 2015. And when we look at houses, look, a better story here, but that's only because of home builder. But we're now tracking below where we were before home builder. So there's no real revival happening in houses either. Perth was the big performer over the month in terms of building approvals, home building approvals. And as usual, Melbourne is the star for home building approvals. It as usual, provides around about 40% of all building approvals come out of Melbourne for housing. And maybe that's one of the reasons why because Melbourne has a better supply line, that it's in a better supply position, and maybe part of the story why it hasn't grown as fast in terms of prices as the other major capitals. But I do think it's a confidence factor rather than a supply demand factor. Latest home loan data, Rich, just quickly. I went too quickly there. we've seen, no surprise, a rise in home lending. I think the interesting thing here is that we're seeing first home buyer numbers falling away. No surprise there, even though investors and total owner occupiers are rising, first home buyer numbers are really starting to fall. And that's because obviously it's very tough with higher prices, higher rents, high prices generally for first home buyers to get into the market, and that's only going to be tougher. And as I said, this is what's really driving social change, I think, going forward by excluding those even more, making it even more difficult to become a homeowner, first homeowner. And we can see when we look at the comparisons of buyer types, investors are up and running, Rich. Look at this. The year to date, 25% higher numbers of investors, and investors are actually now higher over the past year than where they were over the previous year. So I think the appetite from investors is growing. They're looking at prices growth, and they're looking at higher yields and high rents and low vacancy rates. And I'm with you, Rich, surely showing this appetite for private sector investors that the government can find some incentives to get even more investors into the market. This is a private rental market problem. We don't have enough private rental market stock. That's what's causing high rents, social dislocation, low vacancy rates, and we certainly have an appetite there for people to get into the market. So you can have your ideological view of the market, but that's what gets you into the big problems that we have now in terms, particularly of incentivizing private sector investors. Our lending, again, I'll just go back quickly. Western Australia have been the top performers. No surprise, that booming housing market in Perth up by nearly 30% over the year to date in terms of home loans. And what I've done is just reinforcing, Rich, the disparity between, the undersupply. When we look at established home loans versus new home loans, that's home loans for new properties and newly built and constructed properties, you can see how that relationship has fallen away. And if we put that together as a proportion, and now the proportion of loans for new homes is now down to just 19.2% compared to established. So this is the point. We've all got to get out and buy established properties because there's no new properties around. And that only puts upward pressure on prices, of course, going forward. Now, let's have a look at some hard data as we finish off. I'm not going to go through this forensically, but this is our latest rent report. No surprise, rents are still rising over April. Our latest rent report will be coming out next week. April's a holiday month, so we did see a little bit of an ease in vacancy rates, as of course those holiday distractions meant fewer people looking for properties, but vacancy rates for houses still ridiculously low, under 1% everywhere except Hobart. Look at that Sydney median rent, $800 now for a house. And over the past year, we've seen Brisbane house rents up 11%, Sydney up 12%, Perth up 12%. So no good news there for tenants with the latest rent report. A little bit better for units, vacancy rates slightly higher, upward trend. But again, I think there was some holiday influence there over April that just pushed our vacancy rates up. Still very low and well below the 2% sort of balanced mark that we use. But we can see there again, high rent increase, particularly Brisbane up 14.5%. And Melbourne's reviving now, its house unit rents up 16.3%. Investors are now starting to chase these higher yields that we're seeing in some Melbourne suburbs, which have yet to see a strong price revival, but are seeing a strong rent revival coming through. And as we've discussed with those underlying drivers, really no sustained relief for tenants going forward. If you want to get a copy of the rent report, the latest rent report, I'll just leave that on for a second or two. In fact, no, we will leave it till the end because you can get a copy of this report and that will take you to the rent report. Latest home prices over April. We had a consolidating month over April. National house prices rose after a strong March, which followed a weaker February. But we have seen house prices rising over 15 of the last months. These are quarterly house prices that are taken on a month-by-month basis. Again, all the capital cities, with the exception of Hobart, recorded higher house prices over the April quarter, with Perth the top performer, no surprise there. And look at Perth house prices, up by 22.8% over the past year. Strong result there for Perth. National unit prices also up higher over April. As I say, look out for the Friday latest data for May. Similar results there. Again, all but Hobart and Darwin recorded higher unit prices over April compared to the March quarter. And Brisbane unit prices up by 22.2%. And that's a big unit market in Brisbane, and still seeing very strong prices growth for units. Perth up, smaller market in Perth, so they can be a bit more volatile, those results, but still up by 23.1%. The thing we missed out on here is when we look at the chart here back 2 years, Sydney unit prices, similar to house prices, are only up by a couple of percent over the past 2 years. And that's part of what's driving that Sydney market, Rich, is the value opportunities that still exist in the Sydney market because prices are still around about where they were a couple of years ago.
Yeah.
That's driving the Sydney market. And when we look at Melbourne, Melbourne's actually a couple of percent below where it was 2 years ago. So some really good value in that Melbourne market and the Sydney market too. And I think that Sydney market's taking advantage of that. And the Melbourne market, I think, is primed to take advantage of that as well. And that's the QR code for our download. So let's have a look at our forecast for house prices for this year. This is the long-term journey of house price forecasts. If you read anything about 10, 20, 30% price falls that are predicted by some, unfortunately, the banks have been good at that, and they haven't been very good at getting it right, though. This is the long-term journey for Australia's capital city house prices. The worst result we've had on a December quarter to December quarter basis was 5.5% in 2018. And then we had 4.3% fall during the higher interest rate period. And then we bounced back with 8.5% last year. And we're up so far 3.9% this year so far. And that'll be higher when we get our May data out. So the reality is a very robust and resilient housing market in terms of the long-term journey. So, you know, these predictions that are made, just have a look at the data, please, if you're going to make some silly prediction. Because, you know, we've never even got close to 10% falls over a year in capital city prices. So these are my individual forecasts. I think we'll be pretty close to the mark here. We've got to understand that our prices over this year, even though we're seeing some higher results now, will be affected by what was a boom market a year ago. Moving into winter last year, we had one of our strongest winters ever as our markets bounced back. So we have to account for that with our prices growth, which is quite steady and solid at the moment. But when we compare it to that period, it'll just drag down the annual results. But I do think we've certainly got the big three of Perth, Brisbane and Adelaide looking at maybe getting close again to another 10%. We'll see. But I think most of the other results will be pretty close to the mark. I think Canberra, you know, even though it's been an underperformer, it, like Melbourne, is waiting to bounce back. And I think Melbourne also has some risks to the upside. I think we might see higher results in Melbourne there. So as we said, we use a lot of varying models for our housing market, and the weekend auction market is a beauty. That really does gives us an insight into what's happening with the market on almost a real-time basis, on a Saturday basis. You can see their clearance rates versus prices for Sydney. Yep, they track each other, and they track each other for Melbourne as well. So keep an eye out for those auction clearance rates, which we publish every Saturday night. The latest results. The autumn market concluded with some more positives, you know, big numbers of auctions in Sydney, 100 more than compared to the weekend before. Another solid to strong clearance rate, 73.3%. Listings are well ahead still of where they were a year ago, but our clearance rates are starting to fall as that mid-autumn, late to early winter boom started to take effect last year. Same story in Melbourne, higher listings, similar clearance rate. Not as strong as Sydney, but still not a bad result there in most regions for Melbourne sellers. Again, higher than a year ago, but the clearance rate's lower compared to that. Brisbane always has a different culture for auctions. Anything above 50%, usually a good result for Brisbane auctions. And it was similar, even though listings were lower. Adelaide's tracked a little lower than its traditional 80% plus clearance rates it gets. And we have seen perhaps some signs of some easing in that Adelaide market, but it still remains highly affordable. And Canberra had its best result for quite some time, although smaller listings, and we're waiting for that Canberra market to start to pick up. When we look at the trends, we can see, yeah, the trends are still quite good there in Sydney, certainly tracking above April, and that's a good result for sellers, anything above 70%, a little lower than a year ago. The Melbourne market, again, oh, we've just frozen. Is my voice frozen? Oh, no, there's the Melbourne market. Brilliant. So the Melbourne market, lower than a year ago, but just holding its own at the moment. So a solid result from Melbourne. Brisbane, we're just getting a few glitches with the internet here. That's all right. Brisbane holding up compared to the past couple of months, and a little bit lower than where it was a year ago. And as I said, Adelaide's just tracking below those ridiculous 80% plus results it was going, but nonetheless still a seller's market in Adelaide. And Canberra, waiting for that Canberra market to revive. Maybe it is, maybe it's not, but there's certainly it faded at the end of last year and disengaged itself from the Sydney market, and maybe there was a little bit of some of those local policies that were aimed at the housing market in Canberra. That's just created some disturbances in the market. So if you want those auction results every night on my LinkedIn account, every Saturday night around 6:30, you get the latest capital city results, and the full national report is available Sunday mornings on my LinkedIn site, which includes the regional breakdowns for Melbourne and Sydney and the top 10 sales in each of the capital city markets. And just reiterating how strong sellers have been this year. Rich, we can see the actual numbers of sales. So these are actual auction sales. So this puts us together what's sold and what's listed. And this reflects just how many properties have come into the market. We're actually 29% higher numbers of properties sold under the hammer so far this year in Sydney compared to last year. That is a record number for this time of the year. 20% higher in Melbourne, 15% higher in Brisbane, 10% higher in Adelaide, and a little lower, obviously, because Canberra's been a little bit of a struggling market. But these are the actual numbers of properties sold under the hammer. And this is quite a strong result, and shows that these markets are still quite vibrant because of that quantity. So that's our latest national weekend report. You can get a copy of that on the QR code. And just finishing off, Rich, with a summary of what we've sort of discussed today. Inflation outlook certainly is uncertain, still too high, and oil price remains a key, but I think the outlook now is really for steady rates going forward. Still strong national economy, however, is well positioned if we ever did get higher rates. House prices have increased, continue to increase after rising last year despite higher rates. But typically, as we saw, higher rates constrain prices growth and impact confidence, but that underlying demand now, as we've clearly pointed out, is well above supply, reflecting that recent underbuilding and the resumption of high migration. Housing market rebounded last year, despite those predictions of sharp falls, with most capitals last year up by 10%. Latest results revealed generally solid to strong start to this year's housing market, and that will be reinforced with Friday's May results. More positive results to be expected through 2024. National house prices set to rise 5%, maybe Perth, Brisbane, Adelaide up by 10%. So what we tried to focus on here today, Rich, is lots of data, lots of information, because misinformation and ignorance remain the curse of Australian housing markets. You know, think about all those headlines you have to read and grit your teeth to in regard to the outlook for the housing market. And they're like the fish and chip paper, they're gone tomorrow and forget all about it. But if you rationalise and act on all that fear that generates, then you come out with a winner. And it's only going to become tougher to become a homeowner and a home investor. And, you know, the asset class of property is becoming even more of a primary requirement, I think, really, given how we're undersupplied and there's no solution going forward. And as we always discuss in regard to our housing markets, you know, presentation after presentation, cycle after cycle, year after year, decade after decade, there is nothing to fear but fear itself. So there are our capital cities again. Demand is ahead of supply, confidence is high, and prices are still rising. And that's a copy of the whole presentation for those that want it from their QR code. I think we've still got some time for questions.
Yeah. So look, as I said in the chat to everybody, there'll be an opportunity to download. I'll be downloading and sending it to everyone as a PDF document. So that's the other way we can get it to everyone. But what we might do, Andrew, if I just share my screen, we'll just take it off share for a minute, if you may. Just start with some Q&A questions, and maybe we'll just chuck it in reverse order. But Peter's asking, given the state of the property market as you've outlined, a lot of buyers are saying, oh, maybe I'll just wait till later in the year when interest rates cut or the market starts to rise again. What's your response to that sort of thinking?
Well, if the interest rates fall, prices will rise. So you're going to pay more, right? So what it's sort of reverse logic, isn't it? Because as we said, you know, typically lower interest rates, with a given income mean property becomes more affordable. And the underlying element to all that is we've still got a booming economy. So it's
Yeah.
not as though, yeah, well, I'm struggling for a job and unemployment's high. So that sort of offsets, which is typically the reason why we cut rates, is to
Mm.
stimulate the economy, right?
Mm.
So why would you be cutting rates when we've got a booming economy, which
Mm.
may only act to push up inflation, because
Mm.
people go, say, oh, this is great. I've got more money in my kick. I can go out and spend it.
Yep.
So I think that's the point, that I don't think rates are going to fall
Great.
with such a strong economy,
No, it's really good.
and
I
if they
mean,
did, you'd
yeah.
want to get in early, mate.
Exactly. I see. I mean, I've done some analysis of, and one of your slides said 6.8% over the last 38 years. I actually tracked the median price rural capital cities again over the last 20 to 30 years myself, and just extrapolated what Sydney's median house price will be in 5 years, what Brisbane's median house price and Melbourne's median house price will be. And they're pretty scary numbers, right? So Sydney's median house price will be closer to $5 million in 20 years' time. Just
Yeah.
simple compounding growth rates, right? So I guess the question of buy now or buy later, I say buy when you can afford to buy, and buy as soon as you can afford to buy, so that you're in the market and then riding the wave of capital growth that's going to take you forward.
And the point, Rich, the point is that we're in a different environment now. We're in a systemically different environment because
Yep.
we have underbuilt to the point where we can't catch up.
Yep.
So we're never going to be able to match supply and demand, in my
There you
opinion.
go. So there's another reason to invest. So look, we've got a bunch of questions. Let's rip through these quickly. Joe's asking, would Perth be the next Brisbane because of net migration? Does this going to be a structural change like Queensland? Look, I think Perth is definitely a market, as you've indicated, is definitely on the rise. However, its economy, as you would know, is very much tied up with the resources sector. So I think it tends to have periods of time where it tends to go quite well, but then it has longer downturn times. I'm not saying don't invest in Perth, but I would say to an investor, do consider a range of cities that you're going to be investing in. But places like Sydney, Melbourne, Brisbane have a more diverse economy. What would be your view on that Andrew?
Yeah, absolutely, Richard. Look, Perth's coming from a long way back.
Hmm.
I mean, at one stage there, to your point, the Perth median house price was the same as Sydney, back in the early mining boom days. And it really went backwards for a number of years. Now it's catching up. You don't really ever catch up. It sort of readjusts to
Yeah.
everything. And but it is an affordable market. Wages in Perth are the highest in the country, and yet prices are the lowest of the major capitals. And that's
Mm.
why it has potential to grow, because it has those affordability advantages. But it doesn't mean necessarily that you're going to maximize that at the same level that the other capitals are doing.
Yeah.
So yes, plenty of upside to Perth, but you've got to understand that it's compensating for all the downside that's happened, and its prices are still well below, Adelaide
Yeah.
and Brisbane.
Cool. Okay. Someone's asking, is needed gearing at risk if the next federal government, including the Greens, get to majority government? My view on that is that it's unlikely, very unlikely, if Labor stays in, that negative gearing would be cut, because they were officially trounced in the
Yeah.
2021, 22 election when Morrison won. And they did bring that to the election platform, but were roundly criticised and defeated on that. So, and again, we know that if you take out more private equity, private landlords from the
Crazy.
market, it's just going to exacerbate the housing problem. So I don't think that's going to be a sensible policy for any party apart from the Greens, who are very left wing, to bring up as a major policy platform.
Look, it's lunacy, Rich. I mean, why have fewer investors rather than more investors?
Hmm.
I mean, it's been shown that just because you get rid of an investor doesn't mean automatically you get a first home buyer jumping in to take up that property. All you get is high in this environment. The investor will go, okay, I've got less of a benefit. I'll just put up the rent, and that'll offset that. And look, any government. I mean, Bill Shorten lost the unlosable election, as you said, in 2019.
Yeah.
And part of that was certainly the negative gearing, travesty that
Yeah.
the Labor Party went with. And they've, promised on a stack of Bibles they're not going to do it again. Well, what does that mean? But, it would be, I think, death for any, particularly given the terrible state our rental market is in. Surely logic tells you that, the ideological claptrap about getting rid of investors has failed to the point where we have probably the worst rental market in our history,
Yeah,
right? We need to incentivize more investors and acknowledge the fact that Australia has 40% of its stock is private rent, of its housing stock is
exactly.
private rental
Exactly.
stock. You
Yeah.
can't move away from that. And mate, they all vote.
Yeah, yeah, cool. Someone is asking here, are any insights into why approvals are down? Is the catch-22 of building costs increasing at a rate higher than the returns, so investors are wanting to build? What's your view on that question?
Well, it's obviously we've had a massive increase in house building costs, Rich. I'm surprised we've even continued to have a reasonable amount of approvals coming through because, we at one stage their house building costs were 22% higher over the year, which is just ridiculous. They're still 5% higher, which is still a mountain to climb for a lot of builders for profitability because typically, it's a highly competitive market, margins are low. And so they can afford, or they typically have, like 3 or 4%, even lower, cost increases, annual cost increases. It's still at 5. It's heading in the right direction, but it's sort of Murphy's Law, it just sort of all
Yep.
conglomerates together with
Yeah.
all bad news.
I
And
think another reason I think why approvals are down is that a lot of foreign, what do you call it, the taxes on foreign
yeah,
buyers is so high, unfortunately, and they've been used as a scapegoat in this
yes,
argument. And in fact,
crazy.
if you allow foreign buyers, they are the ones that typically buy the brand new stock, which increases housing supply, which the locals typically don't buy. So, in a way, they've been demonized as being a detriment to our housing market, where actually they've been a savior. And
Yeah,
until such time as we actually get back to a situation where we allow foreign investors without massive taxes to come
yeah,
into the market, that will actually improve the rental. Well, it'll stabilize the rental
yeah.
market, and it will actually improve the stock of housing.
Yeah, it's the stupidity of the housing policy that we're infected with, and we're not alone. The UK, Europe, and they're all paying the same
Mm.
price
Mm.
because if you're a foreign investor in a property here, you can't live in it unless you've got a visa. So all
Mm.
it's doing is providing a roof over a head to an Australian who has
Yeah, yeah.
either a temporary or a permanent visa. And if you lose your temporary visa, you can't live in it anymore. It's just, look, it's, sort of xenophobic crap. And it's just, people don't think their way through it. But hey, you wouldn't want to be looking for a rental property for quids, would you, Rich?
Tough. Yeah, it's pretty tough at the moment. Another quick question. What's the outlook for the Canberra property market, Andrew?
Yeah, that's very interesting. I've done a couple of gigs lately about Canberra, Rich. I'm actually reasonably bullish about Canberra only because it faded away at the end of last year. It sort of disengaged from Sydney, which normally tracks Sydney pretty well. I'm thinking we're talking about housing policy. There's been some really interesting policies introduced by what is a left of centre government in Canberra. In terms of property taxes and changes to the way they tax property. And I'm just wondering if there's a sort of a quid pro quo in terms of what that's done to the housing market
Mm.
in
Mm.
Canberra. Like it's, beware of the law of unintended consequences. And as we've seen, voters, constituents are not going to put up with not being able to put a roof over their head, regardless of how solid your political position is. It gets very, very dicey if all of a sudden prices are starting to ease when everybody else is rising. But the other point to Canberra is, and that really does affect houses rather than units. The unit market's still quite reasonable in Canberra, and I think there's some upside to Canberra because at the end of the day, all the other drivers are positive for Canberra: low unemployment rate, low supply, basically. And I do think that there are opportunities for a revival, similar to Melbourne, in that Canberra
Mm.
market as well. But it is taking its time to sort of pick itself back up again. But that clearance rate last weekend, 66.6%, was a good early sign. But we've had sort of stops and starts for Canberra. But I do think it's certainly value in that Canberra market at the moment. And still the unit market's performing reasonably well. It's the house market that's not doing as well. And
Yeah.
it's interesting.
Okay. Another question here, which I can answer. Will Melbourne catch up with other cities? If so, within what time frame? Typically, we've seen that Sydney has always led the housing pricing across the Australian market, and Melbourne's typically been about 30% below Sydney's median, and Brisbane's about 40 to 50% below Sydney's median. But we've seen those numbers or relativities change, where Brisbane has almost caught up to Melbourne because Melbourne has gone backward or just stayed where it is. So, but Andrew, there's that common phrase. It's called reversion to mean, right? And we also got a large number of migrants that often end up in Melbourne because
Yeah,
there's some really strong migrant communities there.
yeah,
And that's not going away. And in fact, Melbourne has outgrown as being Australia's largest city, according to the statistical changes. So in my view, Melbourne is primed for growth. It's just not happening right now. But it's one of those, if you're an early adopter and
yes,
you've got the ability to buy a property that doesn't need to necessarily be positively geared, but you're purely looking for capital growth, then Melbourne would be number one on my hit list as a target. So that's what my thoughts are on that one. What's your thoughts, Andrew?
yeah. As we discussed, I'm on board. I mean, it's got certainly upward potential for migration. It's underperforming versus Sydney, which is unusual at the moment. Um, but and its rental market is starting to really pick up. Now there are suburbs in some suburbs in Melbourne that you can get an 8-9% yield because high rents are sort of moving so quickly above prices. You can get, and that's starting to attract investors who think, oh, hey, 8-9% yield, potential for growth, and you can get a reasonable entry level. So you're not talking Sydney here where the median's $750,000 for a
Mm.
unit, right? You're talking Melbourne where the median's still in the 400s.
Yep, that's
So I
brilliant.
think that's this is part of, as you said, the evolution that it
Mm.
starts to build on itself because value is irresistible, Rich, particularly in an environment where we don't have enough houses, mate.
And apart from the value proposition and affordability, there's also the lifestyle drivers, there's the
Yeah.
jobs, and there's the family connections.
Yes, yes, yes.
There's all of those different drivers affect property markets in different ways. But look, that's a topic for another day. A couple more questions. Thanks for the insights. What's your outlook on Adelaide the next 3 to 5 years for the Elizabeth area, especially supply that will come from the new estate in those areas? What's your thoughts on Adelaide, and do you know the Elizabeth area at all, Andrew?
Yes, absolutely, Rich. And of course, Adelaide's been a very strong performer. People tend to forget it actually performed nearly as strong as Brisbane through the COVID period. And there was some migration that headed into Adelaide that was part of that story. But affordability, of course, from those that have come in, that did come in from the Eastern Seaboard, was part of what drove up prices and rents in Adelaide. But I think the big change in Adelaide, and we saw it with the unemployment rate, has been an improvement in its economy. Its economy, if we don't have to go back too many years to see, it was a bit of a basket case, that Adelaide economy. And a lot of that was because of what happened in Elizabeth, where they lost the car manufacturing. And of course, Elizabeth is a very, I guess you'd say, a working class area. But I can always remember the prices there around about 200,000. You could get a house in Elizabeth. But of course, with Adelaide being so strong, that's that value proposition again that's driving buyers who are being priced out of suburbs that are closer in to look at those outer suburbs, and that's gentrification at work. And I think we're seeing strong gentrification at work in those northern suburbs of Adelaide, those northwestern suburbs of Adelaide,
Yep.
such as Elizabeth. So yeah, good value there, but no surprise because that Adelaide market is very, very strong, still affordable, and of course it's a very livable environment, the Adelaide market, with its, you can drive through the whole city of Adelaide in 5 minutes, can't you still? But
Yeah, it's a great city. Can I ask a couple of questions? Rich, does the Brisbane market include Moreton Bay, Ipswich, Logan, and Gold Coast? Well, I'd say Brisbane includes Moreton Bay, Ipswich, and Logan because that's sort of a big
yeah,
concern. But the Gold
absolutely.
Coast
No,
is a separate market, but I guess
getting
it's a bit
closer.
like Sydney and the Central Coast. I mean, the Gold Coast has different drivers, but the Brisbane market, yeah, we're very bullish on the Brisbane market for the
Yeah,
long term, particularly the next 10 years, not
yeah.
just the Olympics. There's massive infrastructure, a lot of attractive things, and the Gold Coast too, great value. If you want a value proposition, the Gold Coast. What do you think, Andrew?
Yeah, absolutely. And isn't it interesting that it's now heading towards being Australia's second most expensive,
Mm.
capital city,
Yeah.
and
Mm.
it was sort of maybe always due to catch up. But I think even a year or two ago, if you had said Brisbane would have had $1 million median, they would have carted you away. But it's yeah, and to overtake Melbourne, But I
Mm.
look, it has lifestyle, it has a strengthening economy,
Mm.
and it still has affordability,
Yeah.
and as regard to the Gold Coast, it's sort of closing together, and I think that's what we're going to see eventually over the next decade. Is it won't be Brisbane, it'll be Greater Brisbane because it'll just be,
Exactly. Yeah.
Toowoomba, Gold Coast,
Well, the
and
Gold Coast used to be, you have to make a sacrifice. If you moved to the Gold Coast before COVID, you'd make a sacrifice in income because the job markets didn't pay as much. Now, with working from home and remote working, so many people have moved up there and can still earn the same money they earn in Sydney or Melbourne. And just, they might commute back, a couple of days, a month or a week, whatever, but enjoying the benefits of that lifestyle. Last two questions we've got. What impact do you think the government's crazy plan on super changes will have on the market? I presume that person means the cap of $3 million on super. Is that what you think it means, Andrew?
yes, likely these things are marginal, I think, at best going forward. The market's driven by fundamental supply and demand and confidence factors. And we're talking hundreds of thousands of participants really at any given time in our housing markets. And, it is almost an irresistible thing, isn't it? The superannuation. It's, we do. I didn't have the chart in today because of time, but I do compare house price growth with the stock market. We've had Australia's stock market grow by around about 14% since the end of 2007. I have some great debates with my stockbroker friends over this, and they lose them all, but that's another story. But I use that as my benchmark starting point, which was a very strong period in Australia's economy, the end of 2007. And if we track to now, we can see the stock market's increased by 14% since then. The All Ords, Sydney's house prices increased by 180% over that same period. Brisbane up 120, Melbourne up 106. So, you can see the story. But I think that sort of equates to, and in fact, if you had to put your money in the bank, that would have risen by 15%. By 75% over that same period. So we have some issues with our stock market, and that's where our super funds mostly go.
Yeah.
And again, that just sort of reinforces the importance of property. But look, it is, almost an irresistible urge for governments to tap into our super funds in one way or the other. It's like they just can't ignore that big bucket of money. But it really hasn't done us a lot of good when we compare it with what's happened with property. And even the US stock market has increased by 180% over that time period. So I just had to put that one in, sort of an opportune moment.
That's great. Thanks, Andrew. Look, I think we're going to have to leave it there. Just to finish up by saying that if anyone is out there looking to buy a property at Property Buyer, we'd love to help you as your buyers advocates. I think everyone who's on my newsletter gets my regular updates, but just as an update, we provide a range of strategies to help you search, appraise, and negotiate for property. So please reach out if we can help you. If you wanted to do a strategy chat, please reach out to us, and we're delighted to help you. Andrew, thank you so much for giving up your time, your insights today. Really appreciate it.
Good on you, mate. We'll catch up soon.
Will do. Thanks again. Thanks everyone for watching, and we'll be sending around a follow-up to this webinar. Thanks again, and bye for now.
Thank you.